Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Joining us now, Lori Calvasina, RBC Capital Markets. Lori, there's a brutal drawdown in the Standard & Poor's 500, 0.5%. Over the weekend, lots of gloom. OMG, big tech is done. Is big tech done?
Stuff. And I think I do think ultimately this market will rotate, but I also understand why it's having trouble doing so. And I think part of the reason why it's having trouble doing so is all the economic excitement that we were seeing. I think we saw a lot of it in February, where we saw GDP forecasts for 2024 just ratcheted up really fast in a hurry, in a big way. We're just not getting that. If I look at the 2025 GDP forecast on the ECF, I think it's ECFC on Bloomberg is the function. You can track what the sell side economists are saying every week. And that's inched up from 1.7 to 1.8%. And that's still a below trend level. If you look at some of the quarterly numbers, we're headed into kind of a softer patch of below trend type GDP. That is just not the kind of macro backdrop that typically sees cyclical small caps and value beat large caps and growth. So I think there's this itch that this growth trade is overvalued. It's crowded. It's sort of the earnings expectations are decelerating on the one hand. That all suggests you should be moving out. But on the other hand, you really need these economic tailwinds, and they're just not there. So you've just got these cross currents that are fighting with each other right now.
Lori, are you surprised that in a world where we came into this 2024 and the market was discounting 6 Fed rate cuts, and now we're down to something like 1 or 2. Despite that trend in Fed outlook, the S&P 500 is up 15%. Does that surprise you?
So I think that it makes sense to me, again, in the context of that ratcheting up of economic expectations that we saw for 2024 earlier. If you go back and look at the GDP forecast for 24, last summer it was tracking at 0.6%. 0 to 2% is a lousy environment for the equity market. You typically see stocks go down when you're in economic purgatory like that. But 2 to 4%, and now 2024 is tracking around 2.4. That's typically a very solid environment for the stock market. The average gains, I think, are like 12, 13%, somewhere in there. So we've transitioned from that idea that we're stuck in economic purgatory to it's actually going to be a pretty good year economically. And I think that really overcame the kind of ratcheting down of Fed hopes and dreams, because it was happening for good reasons.
So in a world where it seems higher for longer in terms of rates here, what sectors screen well for you guys?
I don't think that it's any one sector that you can point to because of that. I think you've got to look at a lot of different factors. And I think sector choices are very, very difficult these days. I do think that if we can sort of get the economic tailwinds back on track, then a sector like financials makes a lot of sense. It's very positively correlated with consumer confidence trends, tends to outperform when consumer confidence is rising. These companies don't have a lot of just sort of innate growth anymore, but they tend to really be kind of viewed as the plumbing of the economy. So I think that's one area you can look at, and valuations are still very favorable. I think other than that, if you think about sort of higher for longer, you have to go to the root causes of that. And I do think inflation ultimately is a little bit higher than what we've been used to, which would point you to, I think, things like energy, materials, some of the commodity sectors.
Well, that's where I want to go. Bank of America, Lori, just published Nia Coda over in Europe. And, cute. She says, buy the French dip. It's a beef fond and Worcestershire sauce and all that. But she's going to buy the French dip with all that politics. Lori, in the American markets now, where is your French dip? Where is the opportunity of something that's pulled back and you say, well, finally I can buy?
So, if we look at valuations, I do, again, go back to energy. I go back to financials. Those are still screening very, very well on our valuation framework. And energy, while it got off to a great start to the year in terms of relative performance, has really faded recently. So that's one that we're keeping an eye on there. I think that people keep looking at small caps. I'm sort of sticking on the sidelines with those for now, but we have noticed that if you look at the funds flow data, you're starting to see passive money come back into the small cap space recently. If you look at the latest DPFR data, so I think that's an area to watch. But frankly, I'm just not convinced that it's going to really be able to take off in a sustainable way until the economic tailwinds are back and until you get the cuts in sight.
Lori Calvasina. Seema Shah, Principal Asset Management, and she's got a wonderful, wonderful global perspective tied into what do you do domestically as well. Is the rest of the world in love with U.S. big caps? Do they love, does the city love NVIDIA as much as we do?
Yes, I think they have to look at the numbers, and it's undeniable, the strength. And I think the thing that you continue to see is frustration maybe that people hadn't increased their exposure before. So the same as the US.
So this is important. You studied this, it's like third week or whatever, finance. Do you believe in window dressing? It's June whatever, 25. Paul, June 30th.
I know.
If I don't own enough Apple, I look like an idiot.
Exactly, right? So, you got NVIDIA bigger than Apple, bigger than some of these other names. It kind of came out of nowhere. But how do you think about those big tech names these days? Do we chase them, or do we try to find some other opportunities?
So look, we think that if you don't already have exposure, it's probably not the best time to be adding exposure, but you also don't want to be reducing your exposure at this point. We do think there's other opportunities in the market. We are expecting a broadening out in the rally, but again, this is not going to be anything which is like what you've seen for the big cap space. It's not going to be such a significant move in the broader market. But given the valuations where they are today, and given you've still got a fairly strong backdrop, the macro backdrop is slowing, but it's fairly strong. So you do want to have exposure to other parts of the market. And I think, if you look at financials, if you look at industrials, I think there are pockets which can do well, but not only just in the US. I think you can look outside the US, Latin America, parts of Asia, they also look pretty attractive.
How do we think about valuation here, just broadly defined? I would argue that it seems like the U.S. market would be fully valued to be generous, and that I need to be looking at Europe or Asia. When you talk to your global clients, and is that what they're talking about?
Yeah, it's always been a situation that they look across the global map and they say, wow, the US is so expensive. Why is there nowhere else that you can increase exposure to? And I think certainly for this year, there has been opportunities. Europe, you mentioned, it is relatively cheap, but actually at this point in time, somewhat concerned about where that is going, and actually preference, as I said, Latin America, pockets of Asia, which has still got that exposure to the tech cycle, which we think can continue to do well.
One of the things I look at here is over the weekend, a lot of people, again, desperately wanting to trade or market time the big stocks. I saw a lot of research this weekend. Now's the time to get out. Now's the time to lighten up in that. What's your study at LSE of market timing? Not so much buy and hold, but just extending your belief. Somebody listening right now owns Microsoft. They got lucky, somebody gave it to them, whatever. How do you extend your timeline and not market time?
Well, firstly, I think it's a fool's game almost to try and think that you're going to have perfect timing in this kind of market. And I think what's more difficult about the big tech is that I think that they're macro agnostic. So you almost have to look away from the macro cycle.
What do you mean by that? Macro agnostics?
Yeah,
I lost it in the accent. I wasn't sure. Macro
agnostic. It doesn't matter what the growth outlook is. It doesn't always matter what the Fed outlook is. Those companies are almost creating their own demand now with the advent of AI. So actually what we're doing almost is becoming an individual stock picker and having to understand the dynamics of those specific companies. And to us, it's very difficult to call, but I think that party is going to keep going on for a bit longer.
This goes to Michael Mauboussin and capital allocation. In the standard discounted cash flow analysis, Mauboussin would say, and I agree with him, that you have to put more weight on the individual quarter, the individual years, and less weight on fancy plug-and-chug math on the terminal value. I think there's too much analysis on what's Microsoft going to be doing 7 years and not enough weight on what are they going to be doing in the next 90 days.
And I think that's even more important for technology, because you're seeing that people are trying to understand on a month-by-month, quarter-by-quarter basis of where things are moving. And the thing is with tech, it's moving so quickly, the progress that you've already seen is advancing really quickly that actually, yes, that shorter time scale becomes more important.
All right, let's think about fixed income here, because a lot of folks are saying they can go to a U.S. Treasury, 2-year, get close to 5%. Is that enough, or do I try to take some credit risk here and get a little bit more creative?
So I think at this point with Treasuries, firstly, duration is not particularly attractive at these levels. I think even though you're likely to see Fed cuts this year with a continuation, with a shallow cutting cycle most likely for 2025, plus concerns around term premium, the discussions around fiscal deficit, that actually yields are not going to come much lower from here. For credit, though, there is certainly interesting parts. IG is one area that we are certainly, we do have an overweight to, but we're looking certainly at the quality space.
You've lit up the live chat on YouTube worldwide. People are listening to you and they're saying, wait, Seema Shah is saying ignore macro. Let's be careful about this. Do you think this bull market of 12 stocks, 20 stocks, whatever, is removed from Fed analysis, where it's just about their individual stories?
I do. I don't think the Fed has an impact on these companies. I don't think if the Fed is going to cut in September versus December, that it actually has much of an impact.
This is a huge deal because I'm halfway there. I think it's way overrated. At least Bramo and I go on this all the time. She's like following the Fed thing up, down, side. I'm like, no, it doesn't matter. But you've gone full boat. You've just said you don't care what Chairman Powell says?
I think that it matters for the other 493 stocks. But I think for those 7 or however many we want to call it now, the magnificent ones, the Fed is not relevant into that analysis. But for that broadening in the rally, the Fed does matter.
Yep. Hey, Seema, how do you think about alternative investments, private equity, private credit, hedge funds, things like that? Where do you think that those belong in a portfolio today?
Oh, I mean, they absolutely need some kind of allocation.
Okay.
The returns are, to get the returns that people are looking for over the next 5-10 year period, if you don't have exposure to big tech and they're not going to keep delivering at the same pace that they've had, you need to look outside your traditional areas. So we are looking at the alternative space. I mean, even within the alternatives, a lot of focus on real assets because of inflation mitigation. But certainly on the private space, I think there has to be allocation to private credit.
In the time we've got left, you are of Aldrich and London School of Economics. How do you play the election in the United Kingdom? Is it a footsie opportunity? Is it a gilt opportunity? I get all the consensus in that. Forget about the gaming of the election. But is there an opportunity there for investors looking at 3 years?
So it depends what I'm assuming the Labour is going to win. If the Labour Party is really going to think about what is going to make the UK attractive to investors again, whether that's thinking about the EU trade relationship, whether it's thinking about capital gains tax, that has the potential to really improve the attractiveness of the UK. But we're still waiting to hear it because they haven't said much about it in their manifesto.
Have the pro-Brexit people, have they admitted that maybe that it hasn't worked, it's not the right decision, or is it still so partisan?
It is still quite partisan, but you are seeing more and more people becoming fairly quiet about the subject, which I think is an admission that it didn't work out so well.
And is that kind of what the data is showing you, that it has not worked?
The data is showing that all the promises that were made in the event of Brexit have not come to fruition. And as a result, the economy has not benefited from that crisis.
And you guys can't fix that overnight.
Can you see her? She could be on ITV or Sky.
I know.
She worked at Treasury, so,
Oh, boy.
She could be a pundit,
I need to go to the London School of Economics.
It's a great school. Great school. Thank you, Mr. Robbins, and Darren Dorff, and the rest. Seema Shah of Principal Asset Management. With Fordham Global Insight, a 3-hour conversation is in order. Tina Fordham joins us this morning. Tina, it's a quiet summer in Europe. My word. Tina, let me get to the July 30 French election. I guess its impact on all of us. There are two. Does a pro like you just ignore it and move right on to July 7?
Oh, I wish we could ignore it, but no. In fact, the first round is this coming Sunday, and the second round is July 7th. So we've got the 2 rounds. The first one in just a few days, Macron gave himself the least time possible, really, to call these snap elections, and it's thrown the whole French political spectrum into disarray and woken up those of us who haven't spent a lot of time focusing on French politics. I mean, really, since Macron took office in 2007 with his centrist party.
My basic take, looking at all of this summit, including the U.S. debate and that, is that if Macron is defeated, it's some form of conservative right-wing coalition. Is that feasible, or are the polarities so fractious? Even that's not going to happen.
Well, first of all, the French political landscape is highly charged and highly fractious. And lots of the political parties' names start with R, so they sound the same for outside observers. It's going to be confusing. Renaissance, Rassemblement, Reconquête, this sort of thing. Macron's party is center-right, so, you know, that's worth restating. It's the populist right under Marine Le Pen that has been working hard over the years to normalize and kind of mainstream itself, that looks like it stands to benefit. But the mathematics on this 2-round race and the 500 and something mini elections that take place make the calculations really difficult. And so first of all, just coming up with scenarios, which is what you would normally do in this situation,
Paul,
is difficult.
Yeah, Paul's looking for dressage tickets down the Seine River at the Olympics. Paul, what do you got?
Let's go to the UK here. Tell us what we should be thinking about here, Tina, with the UK elections.
Well, the UK elections are on the 4th of July, so in between the 2 rounds. I have been saying for some time, I mean, first of all, the UK elections were due this year. They had to be called, they could have been called by January at the latest. Still, the timing is, you know, a bit of a head scratcher. It's not usual to try to make people come to the polls in the height of summer and mess up everyone's summer vacations. Sunak, you know, is widely rumored here in the UK to be be looking to get back to California and join Nick Clegg somewhere like Meta in the Silicon Valley. But he insists he wants to remain in his Yorkshire constituency as an MP. That's something that's unusual about the British system, that politicians stick around. Theresa May has stayed on as an MP. But in this case, the UK is bucking the trend for the rest of Europe, which is moving far right, in fact, and looks likely to vote in a Labour government by a landslide.
And that's kind of where I wanted to get to. How do we, for our audience here in the United States, how do we think about, some of these European countries really moving to the right? And you mentioned, we were talking about France earlier, and the UK going more to the left. What does that tell us? How do we think about that?
Well, so the UK is an outlier in the wider European trend with that in mind, but we've had 14 years of a Conservative Party government. 14 years. That is a very long stretch. So first of all, it's an anti-incumbent move. Secondly, 8 years ago yesterday, and I can't believe it was this long ago, we had the Brexit result. Brexit has been the elephant in the room during this campaign because nobody wants to tell voters they voted for something that, went the wrong direction and that they possibly misjudged the outcome. But it has undoubtedly made people in Britain poorer. And they do understand that Brexit is the main cause of what ails them. It just hasn't featured in the campaign, which is odd.
Tina, one final question. Let's drag you back to the United States of America. What will you look for in the Thursday debate?
Well, signs of life. I think we'll all be looking for sentience and signs of life. One of my clients in private equity in the U.S. Described the race as between demented and dementia. I don't know if you use these kinds of technical terms on Bloomberg Radio, but I think a lot of Americans see it that way. And you're going to have the two of them side by side. People like me will be getting the popcorn out as well as covering it. Arguably, the bar is higher for Joe Biden because there has been this relentless kind of narrative about him being a doddering, old fool. And Trump comes out guns blazing with, what is really also a meandering way of expressing himself. But the other side of it will be, how does this work without a studio audience? Someone like Donald Trump really, I think, needs the energy of the crowd. But this was a condition that reportedly President Biden required. So the debates rarely move the needle on polls, but it will generate headlines, and perhaps it will mean a bit more in a race like this, where so many Americans really don't like either candidate.
Tina, thank you so much. Tina Fordham with us, Fordham Global Insight, I should say, Fordham Global Insight in London.
I'm looking for a man in finance, with trust fund, 6'5", blue eyes.
I'm looking for a man in finance, trust fund, 6'5", blue eyes, sharpish, brain bud, sharper, jawline, bad boy.
Okay, that's enough of that tomfoolery. See, Sweeney's got the jawline. I don't have the jawline.
Tom's 6'5".
This thing won't go away. That's Sad Alex.
Yep.
Sad Alex.
Okay, all right.
Oh, yeah, I'm getting it at home.
Yeah.
I come out of the pool with my floaties on, and the brat afterthought goes, yeah, you look like a man in finance. With the newspapers, because this won't go away this summer.
It will not.
The babe in finance, Lisa Mateo.
There's so many. Yeah, the girl on the couch did the song. She struck a deal with Universal Music Group. It's on Spotify. I mean, it's going crazy. But what it's also done, it sparked this trend because in the dating scene, finance bros are becoming the latest hot commodity, okay? Women want the finance bros. There was one woman, I remember on social media, she held up the cardboard sign and she said she was looking for the man in finance.
The article says it's like actually a national thing.
It is. Yeah. It's growing.
It was a thing back in the 80s. Let me just tell you that.
Okay.
So maybe it's coming around again.
Deep in the song, when Sad Alex does this, deep in the song, there's a beautiful, I can't paraphrase it even, but she says, basically, you're working so many hours a week, just give me the keys to the place in the Hamptons. Yep. Does anybody understand these animals work 65 hours is a slow week?
Yep. That's what one woman who said, they actually interviewed, this in the Wall Street Journal, she said she dated a man in finance. She's like, listen, you're never going to see him. Yeah. just put it straight out there, just letting you know.
The wonderful girl at Penn State nailed when she invented this madness. Maybe it'll go away by August. Next.
By the way, I put a little man in finance tribute out to you. Do it on Twitter, Tom, so you got to check that out.
Yeah, I saw that. PR people called up Ushi.
Okay, here we go. This is going to spark something with you, Tom. The high-end pet care business. It's sparking this booming market. But here's the thing. It's forcing a lot of people into debt. There was one woman, she said she had this MRI scan for her dog, $2,000. Now she's paying 30% interest. The dog has no regrets, but a lot of people maxing out credit cards. They're tapping into retirement accounts, taking out loans for some of these expenses for their pets. I mean, they love them. People are more attached to them nowadays.
I would be careful here because, I've been chastised at party. People really care about this.
Yes.
I'm in the camp like the old days where a dog's a dog, move on, or cat, whatever. We love them all and that. But you're right, people go mental. I mean, Chris Whalen, I go to the Horace Mann Veterinary Clinic.
Oh, okay.
I just write a tuition check out to Horace Mann for the doctor. Chris Whalen goes to the Preferred Dividend Veterinary Clinic. It's in Midtown somewhere, where the only way you pay is with JP Morgan Preferred Dividend shares. I mean, the bills get that high.
That's how they do it. But you pet people? I'm not a pet person.
I'm not a pet person. Okay. I don't. I had one growing up, but
I just got Vet Bill's teeth done. Are you ready?
Wait, what?
The thing now is to avoid major issues when they're 8 or older.
Okay.
Is you get, like we get our teeth cleaned, except you get your teeth cleaned and it's like, a rounding error. $1,300
For one dog?
Yeah, and Kennel Fee, who's like got the IQ of a Kardashian, Kennel Fee wants whiting as well to make them brighter, and it's out of control. Next.
It's crazy. Okay, I want to talk about Netflix. This was really good. You mentioned Lucas Shaw, writing from Paris for his latest newsletter, okay? He was talking about Netflix, one of the biggest players, but when it comes to advertising, he says, not so much. He says the setup for success was there. Netflix, they built this advertising business with the help from Microsoft. They added that advertising-supported tier for subscribers. But in the U.S., their advertising tier, it's just a fraction of the size of Peacock, Hulu, Disney, Amazon Prime. They didn't deliver as many impressions. The relationship with Microsoft is now strained, and it lets go of its head of advertising after a year.
They're not Amazon.
They're not.
They're not, and it's okay. They don't have to be, but they will get it because advertisers will come to them, even if they don't even ask. Advertisers will come to them because that's where the eyeballs are. So they'll get their act together. I'm not too worried. They will be a serious advertising player.
Lucas alluded to that. Well, I think my amateur take is Amazon's sort of on a roll right now.
Oh, Amazon's just awesome. I mean, the big concern was there's only a duopoly here. Kind of Google and Facebook. Now you have a viable third digital advertising alternative, and that's Amazon.
There's a guy out on YouTube live chat. He sends his dog. It's one of those yap dogs, weighs like 8 pounds, to the Marie Antoinette Veterinary Clinic.
There you go.
I mean, I can't imagine what the shampoo and the nail cut costs. Next.
And this last one is just a look, this from Fortune magazine, remember how Walmart came out with this new managerial pay boost? They wanted to boost morale and help reduce turnover. So they raised their manager's salary. So there's one manager, he was straight out, and he talked about his salary. He's 45, his base salary of $168,000. He's a Walmart store manager after that increase. But he said with bonuses and stock grants, Walmart says he can make up to $524,000 a year as a store manager. This is a guy who's a Kurdish immigrant. He turned to the retailer in 1999, started as a part-time worker, making $8 an hour, and he just kept moving up the ranks. Nice. No college degree, just kept moving up. I mean,
some of these Walmart stores, they employ hundreds of people. Yeah. And I mean, it's a company in and of itself. These individual stores, it's a meaningful small business.
And like we look at UPS and 170,000 and this wonderful story. What enthuses me is in that store, there's probably 20 other people on the same track, and they're not getting the headline 500,000 income. But you got people starting, like you say, at $8 an hour, $12 an hour. And
they stick with it.
They're popping 150, 170, 200. That's really cool.
It is. Cool. They stick with
that was strong. Let's do Finance Bro every day this week.
Exactly.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.